Shares of SOFI soaring.
SOFI is getting a boost today after reporting record adjusted net revenue for the fourth quarter.
Look at SOFI. That stock is up more than 14%.
Look at SOFI. Very impressive day for the stock.
SOFI with a double beat.
Yeah, I just text Anthony Noto because I think this was a remarkable quarter.
SOFI reported Q4 earnings today, beating on both the top and the bottom line, and some of the numbers that they reported after diving deep into their report will come as a big surprise to some investors. In this video, we're going to be breaking down the full earnings, the earnings call, and several interviews that Anthony Noto did today. It's going to be a huge video, so let's dive right in. Now, this is going to be a big video, and it's going to be a structured video after having had a chance to read through the report and digest it a little bit. If you want my raw thoughts, you can see them live in the moment as we did a 2.5-hour live stream when SOFI first reported, listening through the earnings call together with the SOFI Weekly podcast. One thing I will mention is this video took a long time to prepare, so if you do enjoy it, please subscribe to the channel for more content. So let's start off first with the top level numbers. SOFI beat on the top line, reporting $457 million in revenue, up 58% year over year versus the $425 million that analysts were expecting, and a whopping beat on the earnings per share, coming in at negative 5 cents EPS versus negative 9 cents that analysts were expecting. Fourth quarter adjusted EBITDA was $70 million, increasing 58% sequentially, culminating in a full year positive adjusted EBITDA of $143 million. And while we're on the EPS point, just double tapping on it for a second, because negative 5 cents EPS was one of the numbers that surprised me. I think many bulls have been expecting profitability for SOFI in 2024, and with the company hitting this huge beat on the bottom line, many people are now looking towards 2023. In fact, Anthony Noto even confirmed profitability expectations for Q4 of 2023.
Really hard to find a company doing what we're able to do, and it's really driven by the diversification of our business across being a one-stop shop for your financial needs on a mobile phone. And we're looking to do roughly $1.9 to $2 billion of revenue, up 25 to 30% in 2023. In addition to achieving GAAP profitability by the end of the year in the fourth quarter.
And just to emphasize this trend, looking at the earnings per share number for the past 4 quarters, EPS has gone from negative 14 to negative 12 to negative 9 to negative 5. Very, very quickly approaching profitability faster than most people are thinking. So this was one of the numbers that definitely surprised me off the bat. Now, in addition, before we go into each segment specifically, SOFI started out their earnings presentation with a 2022 year in review slide, which featured a timeline around all of their major releases for the year, broken out by month. And there's a whole bunch of news pieces here for 2022, starting off with a bank charter in January, margin trading, Technisys acquisition, SOFI Plus launching, options being rolled out, Pay in 4, and many, many more points that they have throughout the year. From a member perspective, they added 480,000 new members in Q4, bringing the total members to 5.2 million, up 51% year over year. The company added 695,000 new products, bringing the total products up to 7.9 million for the full year, up 53%. In the earnings release, Anthony Noto highlighted that our strong momentum in member and product adds reflects the benefits of our broad product suite and the financial services productivity loop strategy. Now, the slide highlighting the productivity loop was one of my favorites in the entire presentation because this is my entire bull thesis. This increased from 3.8x up to 4.9x. Now, this productivity flywheel is increasingly important as one member has the potential to buy multiple SOFI products, thereby increasing that revenue generated for that one member. In other words, the higher this flywheel goes, the more financial services products we have for lending products, the more diversity we'll have in the offerings from a consumer perspective, because members are going to be trying more SOFI products, and the company is going to optimize revenue that they gain from any single given member. So this is very important because after some time, it doesn't really matter how they get a client in the ecosystem, but that they get a client into the ecosystem because that client is so much more likely to try all of their other products. Now, let's jump into some of the segments. SOFI saw record revenues in all 3 of their business segments: lending, technology platform, and financial services. Let's dive into these segments, starting with lending. Lending is made up of 3 segments: home loans, personal loans, and student loans. The total revenue for lending for Q4 was $328 million, up 54% year over year, which brings the full year 2022 revenue from lending at $1.1 billion. Now, the total revenue for lending is made up of two types of income: net interest income and non-interest income. Net interest income was 184 million, up 138% for Q4 year over year, surpassing non-interest income of 144 million for the first time in the company's history. Non-interest income only increased 6% as personal loan originations, which we're going to get to in a second, were offset by lower student loans and home loan originations. And jumping to the bottom line for lending, the contribution profit was 208 million, double year over year, and 664 million contribution profit for the full year 2022, up 66% on a yearly basis. In other words, their expenses only increased 22% year over year, whereas the net interest income increased over 100%, and their non-interest income, which has been hurt by home and student loans, still increased 27% on the back of personal loans. Now let's look a little bit at new originations for Q4 in the lending segment. Originations in Q4 decreased 21% year over year. The story here is really similar to previous quarters that we've talked about, where personal loans is on an absolute rampage, completely offsetting student and home loan declines that we're seeing as a result of the macro. So from an origination perspective, in Q4, personal loans increased 50%, student loans hurt by the moratorium declined 72%, and originations for home loans declined 4%. This also marks a decline in home loans and student loan originations for the full year as well as for Q4.
Anthony, once there is resolution on the student debt front, how do you expect the trajectory of your student loan business to fare?
If it comes at the end of the period that he's articulated by June, and then there's a 60-day period for the servicers to start the payment send out process, we don't believe we'll see a pickup until that time period, so August, September. And we actually don't believe it will go straight back to where levels were prior to 2020. Just given where interest rates are, it's likely to be a slower build. But that's all factored into our 2023 outlook, which is still quite robust.
In other words, reading between the lines, they're not really accounting for anything student loan growth in 2023 to make any significant impact onto revenue. Now, on the home loans front, Anthony Noto mentioned in the earnings call that they continue to transition to new fulfillment partners. They explained how they had a previous fulfillment partner and that partner basically got acquired and it would take them too long to migrate. And as a result of that, they transitioned onto a new fulfillment partner. This has been an ongoing endeavor. However, Anthony Noto expressed optimism, saying that they've made more progress in the last 2 months than in the previous 18 months combined, and they fast-tracked a new fulfillment partner. So he expects that this should be completed by the end of the year. Home loans is basically going to be on pause until that happens without any major change happening for the rest of the year.
On the home loan side, rising rates have really dampened the demand for home purchases, as a home is more expensive with interest rates over 5%. And we're also doing a re-architecture of our back end so that we can deliver a time to fund of 30 days on a home purchase. So we've taken our foot off the gas pedal on home loans, put more resources against personal loans, and that's carrying the weight in the lending business.
And interestingly, in the Q&A portion of the earnings call, after analysts started asking about this, they reiterated the point that they want to bring home loans in-house. This is nothing new, but when you take into account the fact that their other partner got acquired and it's causing them this 2-year delay in ramping up to a new fulfillment partner, it wouldn't be surprising to me at all if SOFI is looking at the current fulfillment partner that they're ramping up on right now as an acquisition target. Of course, I don't think we're going to see anything in 2023, but definitely in 2024 or 2025, the writing is on the wall for them to purchase something on the home loans front from a fulfillment point of view. Now, just pivoting over to this chart, we can see another interesting little tidbit, the average loan balance for each of these segments. Personal loans, for example, has an average loan balance of $25,000. Now, this is defined as the total of unpaid principal balance divided by the total number of loans outstanding. Student loan average balance is a little bit higher at $46,500, and as you would imagine, home loans is the highest balance of $285,000. So if you think about new originations, we're doing fewer student loans, we're doing fewer home loans, and we're doing more personal loans. As a percentage of the total pie, the average loan balance, when we aggregate everything together, would be declining. In other words, basically saying that SOFI doesn't have huge loan balances outstanding since every new origination is mainly coming from the financial aspect that has smaller average loan balances. And of course, I bring this up as a delinquency risk point, but management also highlighted on the call that the FICO scores remain very, very high for all three of these segments.
We go after what's called a prime customer, high income and high credit. Our average FICO scores are in the 750s, and we manage to a life loan loss of less than 8%. And it's been meaningfully below that. In fact, we haven't seen delinquencies even get back to where they were in 2019. I think we're just one of the few companies that understands how to write unsecured credit. And so we're gaining meaningful market share. Having the bank license also helps us meaningfully. Our deposits are now up to $7.5 billion versus about $1 billion at the beginning of the year. And we save about 190 basis points using those deposits, which allows us to give our members really competitive interest rates on their loans.
As a result of this, members have more borrowing potential and flexibility should any tough times come. So this is definitely a point in their favor. Now, a similar story to products as with originations, personal loans from a product perspective grew at 37%, home loans at 13%, and student loans trailing at 7% year over year. This brings the aggregate blended increase in total products for lending at 24%. Moving on from products onto the tech platform, net revenue for Q4 was $85.7 million, bringing the full year revenue at $315 million for the technology platform, representing a 61% year-over-year increase. The tech platform had a contribution profit of almost $17 million for Q4 and $76 million for the full year. Now, the contribution profit actually decreased year-over-year in Q4 due to higher expenses in that quarter by 16%, but still increased on a yearly basis by 19%. However, excluding Technisys, the contribution margin was lower in Q4, 24% versus 38% the year prior. From a client perspective, the tech platform grew clients 31% year over year to 130 million, up from 99 million a year prior. On the earnings call, the team was asked to expand on the 31% increase in clientele, to which they said they landed 11 new clients in Q4, 9 of whom have established existing clienteles, 4 of which are in the B2B space, and 3 of which are outside of the US, located in Mexico. On the earnings call, management also expressed a cost reduction now that Galileo and Technisys are all acting as one singular tech platform. However, I do want to dive a little bit deeper as to the specific hiccup in Q4. That number on the contribution margin perspective is something that I'm going to be paying more close attention to in Q1, because I'm curious as to whether that starts a trend of a declining contribution margin perspective on the technology platform, or whether that's a one-off bad quarter. However, from a B2B perspective, I wouldn't be surprised if that contribution margin continues to fall in 2023, given the macroeconomic condition. On the earnings call, the company was asked around some of the implications of Galileo cross-buying, and they highlighted that they want to focus on durable companies with large installed bases. They added over 20 partners per year, moved to cloud storage from on-premises, increased headcount, and one interesting nugget that they dropped was that they were also invested in diversifying out of ACH and expanding in the B2B space, making particular reference to gig economy companies, which I found interesting. Moving on from the tech platform to financial services, revenue for this segment increased 195% in Q4. It increased 189% on a full year basis to close off the year at 167 million. Now, of the 3 business segments, financial services is the only one that is still reporting a loss. A $43 million loss for Q3, $199 million loss for the full year. And the company here highlighted that this increase in contribution loss was largely due to the credit card business, which launched in late 2020, for which they're continuing to build current expected credit loss reserves. Now, this is nothing new, but here's the interesting part, and I think very bullish part. Management expects this segment to be contribution profitable by Q4 2023, even as the company continues to invest aggressively in members and product acquisition. Now, this is absolutely huge, right? Because if the financial services segment is profitable, this brings all 3 of their segments to profitability, and by association brings the full company to profitability by the 4th quarter of 2023. Total products for the financial services segment grew by around 635,000 to Q4, bringing the total products to 6.6 million by year's end. This was driven primarily by an increase in Relay, surprisingly, which added 322,000 new products, followed by SOFI Money at 193, followed by Invest products at 91,000 new additions. However, As you can see from this chart, all of the products in financial services are growing at a very, very healthy pace, with Invest actually being the slowest grower at only 35%. SOFI also mentioned a key highlight on their checking and savings offering powered by the bank charter, with total deposits for checking and savings grew 46% in Q4 to 7.3 billion at quarter's end, and 88% of SOFI Money deposits are from direct deposit members. Now, approximately half of newly funded SOFI Money accounts are setting up direct deposit by day 30th. This is up from about 25% in the comparable period, and this has had a significant impact on debit spending.
National bank charters really put a wind at our back. It's giving us the ability to offer a really high interest rate on checking and savings, and that product's helping fuel our ability to drive deposits. And then we're using those deposits to fund our loans at about 190 basis points lower cost of funding than if we'd borrowed money from banks to lend to our customers. So the overall strategy is working. We have the flywheel going.
Anthony Noto highlighted that as a result of this growth in high quality deposits, we are benefiting from a lower cost of funding for our loans. Our deposit funding also increases our flexibility to capture additional net interest margin and optimize returns, a critical advantage in light of notable macroeconomic uncertainty. In its third full quarter of operations, remember, SoFi Bank was only enabled by the bank charter, which was acquired in January of 2022. SoFi Bank generated approximately $30 million of positive GAAP net income at an 11% margin. This is absolutely fantastic. And ultimately, this was one of the main catalysts that plays a big part going forward into their 2023 outlook. The business is guiding for adjusted net revenue of 1.9 to 2 billion in 2023, representing a 25 to 30% growth on the top line. They're expecting a full year adjusted EBITDA of $260 to $280 million. Now, just to wrap this video up, because it's gone very long, I'll include some other interesting points that I heard on the earnings call or that I read in the report. This is SoFi's 7th consecutive quarter of increasing net revenue. Almost half of their total $143 million annual EBITDA came from this quarter, where they reported $70 million. SoFi Bank saw higher balances even as spend decreased. Stock-based compensation as a percentage of revenue is down, with the company aiming to bring it down to single-digit percentages. Now, this is really important, right? Because stock-based compensation has been one of the biggest bear cases that we've seen weighing down on the stock. And it's also one of the biggest factors that will push the company towards profitability, because as stock-based compensation decreases, the company can realize more of those profits because SBC is an expense. I did a full deep dive on stock-based compensation. I highly recommend you watch that at the end of this video. I'll attach it in the end. Now, just pivoting to their financials from a balance sheet perspective, SoFi Bank has provided the company more flexibility to lower costs of capital. Assets are up. Tangible book value is growing for the second consecutive quarter. Deposits are up 2.3 billion quarter over quarter to 7.3 billion total. The business is well capitalized and in a very healthy financial position to further capitalize the bank should they want to grow it faster.
We do have ample amount of cash on our own. On our balance sheet, we ended the quarter with about $1.4 billion of pure cash and cash equivalents, another $400 million of investment in treasuries and other securities, and then another $400 million in restricted cash. So really a strong cash position, liquidity position, which allows us to invest. We're at the point now, though, where we can drop about 30 cents of every incremental revenue dollar year over year to the EBITDA line, and that's what's going to allow us to drive to GAAP profitability by the end of the year.
I also found it interesting that some of the macro economy assumptions baked into their guidance is that SoFi is expecting the Fed funds rate to peak out at 5% with 2 rate cuts in 2023, when the Fed basically said that they're not going to cut rates this year. So if the Fed pivots, then great. If the Fed doesn't pivot, then SoFi is eventually going to have to adjust their guidance because they're accounting for 2 rate cuts this year. Chris Lapointe, their chief financial officer, highlighted this on the earnings call. Another key macro assumption in the Q&A portion asked by analysts factoring into the company's guidance were credit spreads. Basically, management said that it's implied that they're going to see elevated credit spreads this year. However, in January, credit spreads tightened, which is a good thing, and we'll see if this has additional upside throughout the whole year. But they're being very cautious right now, particularly in how aggressively they're assuming personal loans will grow. They highlighted in personal loans that there is more room to grow. They currently have 6% market share, up from 4% a year ago, but they're taking a prudent approach to monitoring their credit. Anthony Noto made the rounds today on several interviews. He was on Fox, he was on CNBC, and a couple of others. I've clipped a couple of interesting segments for you, and I'll include them right here.
To me, which is pretty fascinating, your annual percentage yield. As you compare it to some of the other bigger names in the business, you guys are rocking it. I mean, Goldman gives 3.3%, Capital One 3.3%. You can see what Chase and Bank of America are doing. How are you able to do this? And what do you have as sort of a reserve? Because that, we all learned from the financial crisis, is really key.
Yeah, we're able to do it because that's ironically a lower cost than what we used to have to do before we were a bank. Before we were a bank, in order to lend money to our members, we would have to borrow from the banks at about 190 basis points above what we're actually giving to the consumer. So many people don't realize this. When you're not a bank, you cannot use deposits to fund loans. But when you become a bank, those deposits can be used to fund loans.
Right.
And we're aggregating those deposits by paying consumers an interest rate that's higher than the banks give those consumers, and we're no longer borrowing from the consumer, from the banks. We're actually using the deposits. So the reason we can do it is because we have many businesses that can then use those deposits to get a return. And a lot of banks have abandoned many of the products that I'm talking about because they couldn't figure out how to do them profitably. And so they're not in mortgage, or they're not in unsecured personal loans, or they're not in student loan refinancing. And because we have many products and we're a one-stop shop, those deposits, if you think about it, it's like a resource, natural resource that we can use to drive all of our businesses, and that allows us to give the consumer a great interest rate.
Finally, just to wrap this mega video up, we have our first analyst raising price target. Wedbush came in and increased the price target on SoFi to $8, up from $6. And I expect on the back of this fantastic earnings for more analysts to do the same. As a SoFi long, I am very bullish on this earnings. I'm very bullish on the company. Expected profitability much sooner than possible. Fantastic to hear. Overall, I'm very happy. If you enjoyed this video, please subscribe to the channel. This took a long time to prepare, and I hope you enjoyed it. If you did enjoy it, also share this out with somebody else who you think might enjoy it as well. For right now, this is the Fundamentals of Investing podcast. Thank you so much for listening.